Very good morning, friends. Welcome back. Today we will start on the session on pre-shipment credit. So, my dear friends, what is pre-shipment credit? Pre-shipment is also known as your packing credit. Okay, it's a loan or an advance granted. The name already stated as pre-shipment means the loan or the advance granted to an exporter for financing the processing, purchase, manufacturing or packing of goods prior to shipment, so named as pre-shipment. Packing credit can also be extended as working capital assistance to meet the expenses such as the wages, utility payments, travel expense, etc. to the companies who are engaged mainly in export business or service business. In our next session, next slide, we will start with the question and an answer for the pre-shipment credit. Friends, we will start with the question based on shipment. The first questions to start is: an exporter approaches the ABC bank for a pre-shipment and post-shipment loan with an estimated sale of rupees 500 lakh. So what happens is the bank sanctions a limit of rupees 200 lakh out of the 500 lakh with 30% margin for pre-shipment loan on free onboard value, that is FOB value, and margin on bills is 15% on foreign demand bills and 20% on foreign usance bills. The firm gets an order for $60,000 CIF, that is your insurance and freight charges, to Australia. On 1st of Jan 2015, when the USD by INR rate was 65.50 per USD, the firm approached the bank for releasing pre-shipment loan PCL, which is released. On 31st of May 2015, the firm submitted export documents drawn on site basis for $30,000 as full and final shipment. The bank purchased the documents at rupees 65.85, adjusted the PCL outstanding and credited the balance amount to the firm's account after recovering interest for normal transit period, that is NTP. So the question is, what is the amount that the bank can allow as PCL to the exporter against the given export order, considering the profit margin as 5% and insurance and freight cost as 10%. In the next slide, we will start with the solution for the respective question. Friends, we will start with the solution. Remember, what is the question mentioned is to calculate the amount a bank can allow as PCL to the exporter. We have to consider 2 points. The first is the profit margin of the bank 5% to assume, and the second is the insurance and freight charges as 10% to assume. So we will start with the solution. To calculate it, we need FOB value. So to calculate the FOB value, free onboard value, is equal to 60,000. Remember, the firm gets an order for $60,000 CIF, that is your insurance and freight charges, to Australia. That 60,000 we have to take, and it will take in the rate USD by INR rate as on 1st Jan 2015 was 65.50. We will take that rate. So 60,000 multiplied by 65.50, you will get 39 lakhs 30,000 minus your 10% insurance and freight cost. 10% insurance and freight cost to deduct, you get 3,93,000 is your 10%. So 39 lakhs 30,000 minus 3,93,000 is equal to 35 lakhs 37,000. In 35 lakhs 37,000, you have to minus the 5% profit margin. So 35 lakhs 37,000's 5% you will get as 1,76,850. Once deducting, you get the answer as 33 lakhs 60,150. You will minus the 30% margin. Remember, when bank was sanctioning the document, that time the bank has already stated they will add 30% margin they will receive. So that 30% also you have to add here. Out of that 500 lakh, 200 bank sanctioned the limit 200 plus they said they will add the 30% margin. They will receive 30% margin. So we'll take your 30% margin 2 on 33,60,150 minus your 30%. So it will come as 10,08,045. You'll get the final answer as 23,52,105. Thus, the bank can allow rupees 23,52,105 as PCL to the exporter against the given export order. Thank you.